Well, it was an interesting reversal of fortune day today on Wall Street. Recently, we've been seeing the Nasdaq and the Russell 2000 leading the indices to the upside. Both of them did hit new highs today, but it was the Dow Jones Industrial Average that was the only index that finished in the green when it was all said and done today. So maybe some of that money flowing back to some of those mega cap stocks that have been left out of this rally for the most part recently. We did see McDonald's have a big day today as just one example. We also saw some interesting developments within the consumer staples space. So I'm going to talk about that here today. And then we're going to take a look at a consumer staples stock for our trade application example here a little bit later in the video as well. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's June 7th, 2018. If you're new to these videos, we want to welcome you aboard. Remember, you can subscribe to our YouTube channel by clicking that subscribe button. You can also give us a thumbs up if you appreciate these videos, and you're welcome to leave us comments down below as well. In our description area, you can sign up for our email distribution list, which would entitle you to the various stocks that are hitting new bullish and bearish clusters, or overbought, oversold, however you wanted to say that. So make sure you're signed up for that if you haven't done so already. Now, in addition to YouTube, we're also heavy users of Twitter. We'd encourage you to follow us there. My handle is @BrandonVanZee, all one word. And remember, we always pin the Market Outlook tweet to the top of our Twitter profile. So if you get value out of these videos on a daily basis, we'd encourage you to click like and retweet on Twitter as well. And we also have a presence on Facebook. We have a group, and so you're welcome to join our group at that web address you see in front of you. All right, with that, let's dive into the analysis of the markets here today. As you can see, I've got the S&P 500 pulled up in front of us here, and we finished effectively flat. Now, it wasn't a flat day, meaning that we didn't just stay in a small range. You can see right here, our range was a decent-sized range on the day from top to bottom, but where we finished the day was effectively just in line with where we closed yesterday's session. You can see when it was all said and done, we finished lower by less than 2 points, so it was good for a minus 0.07% move on the S&P 500. That by itself isn't anything necessarily scary, but a lot of us can acknowledge that the markets have been very hot here recently, hotter than we would have assumed. There has been some good economic data coming out. You know, obviously the employment numbers are excellent, and we're starting to see some resolution on some of these geopolitical things as well. Of course, we heard some news today about the expectations of President Trump and the leaders of North Korea getting together next week in Singapore. So some positive developments there, no doubt. But it has been a fairly nice run without significant pullbacks here in the last couple of months. And so at some point, you'd think that we'd have to take a little bit of a rest. Maybe today starts that process. We'll just have to keep our eyes on it. But we do have clearly a red candle here. And it gave us the impression that it didn't want to close at new highs here, at least on the S&P 500. When we look at the Nasdaq here in a little bit, it's going to look much the same way. So not necessarily the best looking candle on the board right there. Now, of course, most of us that follow this market forecast indicator that you see down below are looking at it from a longer time period perspective. In particular, the line that gets the most attention is the green line. That's our intermediate term line. Remember, these names here describe kind of the length of time that you might be looking at as a trader yourself to establish your posture. So that red momentum line right there would be for hyperactive day traders. The near-term line is going to be the next most sensitive, and that's going to be your kind of swing traders that would look at that. Most folks are probably in the category of intermediate term trend traders, where they're looking out maybe a couple of months as far as how they're going to set up their trades and their portfolios. So that's why we look so much at that intermediate term line. And of course, one day doesn't change our posture on something like that. So despite the fact that we've got some down candles here on some of the indices today, doesn't change the posture. Our posture remains bullish. In fact, it's strongly bullish. Remember, anytime we've got this green intermediate line up in the upper reversal zone, which means above 80 on this market forecast indicator, it means that there is a strong intermediate trend in play. And until we see signs of that deterioration, we're going to assume that the future is going to be much like the past. So can there be, you know, a week in the middle of it where we have some weakness in share prices? Of course, anything can happen in the stock market. So maybe this is the start of maybe a little bit of a pullback here. We'll have to keep our eyes on it. It's been a good run, so I don't think many people would complain too much if there was a little bit of a pullback. The main thing that we're going to be watching for is when we do get that pullback, whether it starts today, tomorrow, next week, what happens on that swing lower? Does it hold the 30-day moving average? You can see we had a pullback back here at the end of May as well, and we had 4 out of 5 down days. And it ended with us basically sitting right on that moving average. And then as soon as the next day, we bounced off of it. If we get that type of behavior going forward, I think most bulls are completely comfortable with that idea. It's where we start breaking down beyond those levels where then all of a sudden we start getting some concerns that something, you know, a little bit more devastating is around the corner. So if we can hold this 30-day moving average, I'm completely comfortable with having a pullback at some point going forward, even though I am generally more bullish with my portfolio since I'm a long-term investor. So let's go ahead and take a look here at a couple of other charts. Let's look at 4B now. Remember, for those of you that are premium market scholars, subscribers, if you've gone through my charting tutorial already, you can always follow along with us here on the Market Outlook videos. The chart number that David and I are using will be listed in that pink label in the upper left. In this case, it's 4B. So this particular chart setup, what we're looking at here, obviously it's 4 different charts. And so these are the 4 main indices that we track in the United States. And when you're reviewing the background color of the charts, that is signifying whether you have a bullish or bearish posture according to that intermediate term line at that time. So in other words, when we look at all 4 of our indices right now, notice that the colored background behind the candles itself are all green in today's case. So that means that we still have bullish postures across the board. Doesn't matter if you're looking at small caps, large caps, or in between. What I noted in the intro, which was somewhat interesting here today, was the Dow Jones actually finished higher by 95 points today. It was up by 0.38%, which is actually a pretty decent sized day, especially considering context. In this case, all the other indices were down. Remember, a lot of times the markets will kind of move together, up and down. So when you have the Dow doing something that is a lot different than the rest of the market, it's worth pointing out. Now, I mentioned before that I wanted to take a look at the Nasdaq in this case. So the Nasdaq is a chart in the lower left. The other thing I'll point out is notice that we have a yearly high label here on the Nasdaq. We also have it down below here on the Russell telling us that we hit new all-time highs here today, not just yearly highs, but all-time highs. Let me right-click on the Nasdaq chart, go down here to maximize sell. This candle here looks a little bit more serious. Right, the S&P 500 candle was manageable because it was basically a flat day, but the Nasdaq candle, it's a little bit dicier. It's a little bit more bearish at this point. Reason for that is this is what we call a bearish engulfing candle on the Nasdaq composite. What that means is we've got the candle here, the body of today's candle, engulfing the previous day's candle, and we finished lower. So this was a bearish day, all things considered. Again, the posture remains bullish, but we might have a short-term swing back lower at this point. This looks like it's kind of starting to roll over a little bit here, which is unfortunate. Remember, the Nasdaq has been one of our leadership groups recently. Talked about how those FANG stocks have really been ticking higher. But I think we all can acknowledge when we look at this move that the Nasdaq has made, you know, we basically had a bullish posture on the Nasdaq going back since May 1st. It's June 7th at this point. So we're talking about an entire full month of bullish posture without any real give back. So again, I think we're probably due for some sort of a pullback. Whether we get it or not is anybody's guess. What I'm going to be looking for is, do we stay above that rising moving average whenever we do bounce? If we do, then I think, you know, it's all systems go. Remain bullish with your posture in the market here currently. So anyway, keep your eye on some of those high-flying tech stocks. I think there were some that were reporting after the bell actually tonight. Wasn't Broadcom reporting after the bell? Let me check on that real quick. AVGO's ticker symbol there. And yeah, they just reported here maybe half an hour or so ago. Looks like they are trading basically in line with where they went out of the regular session. You can see they closed the regular session at 264.68. They're trading right around that level. Now, it hasn't been an easy move. You can see here kind of in this shaded area, this is the after hours activity. At first, Broadcom did spike all the way up to 268, And then it fell all the way back down here to 262 before kind of coming right back up to break even. So in the end, it's a bit of a wash at this point. Obviously, anything can happen between now and tomorrow morning's open. You're going to have some conference calls and stuff where stocks can make some movements off of that. But remember, Broadcom is now one of the world's largest semiconductor companies out there. That was the company that was trying to buy Qualcomm here a couple of months ago. So we'll keep our eye on that story. But right now, tech stocks in general, a little bit dicey just because of the formation, the candlesticks here on the Nasdaq composite. Let's take a look at some other charts here now. Let's look at the 3 green arrows chart. And here when we're looking at this particular chart, which is 4C for those of you following along at home, when you see the green background on this particular chart setup, it's referring to whether the security has 3 green arrows or not. Now, 3 green arrows, just a fancy way of talking about 3 different technical indicators that a lot of folks will want to see lined up if they want to be bullish or bearish if you see 3 red arrows. In this case, since the background color is green across the board, similar to what we saw with the posture using the market forecast indicator, that's a bullish sign. Basically, it means we've got 3 green arrows. Even on that Dow that had been a laggard, that started as soon as yesterday. You'll notice that we got that 3rd green arrow there in the form of the MACD on the Dow. And so, again, trends are looking pretty strong at this point. Not as strong, obviously, as 2017. I mentioned that on Twitter yesterday. I was happy to see that my Monday sector-based trend trading class account was back to all-time highs. It had been a while. We'd been kind of sitting out, seeing some of those all-time highs in the last few months, but it seemed like 2017, it was every single week we were getting new all-time highs. So anyway, this has not been as easy of a year for trend trading as 2017 has, but on the same token, it hasn't been terrible either, especially for those of you that use kind of looser stop losses like we do in my class with the weekly candles. If you're not getting chopped up in this market and you're giving yourself a fighting chance, you're probably seeing some substantial gains out of some of your holdings here in this most recent move that we've seen recently. So anyway, from a trend trading perspective, 3 green arrows, things are looking okay. Not perfect, but still in a fairly strong trend out there. Let's take a look at our 1040 crossover method chart now. This is chart 4D. Now remember the difference in this chart setup here, we're still looking at the same 4 indices, but here we're looking at longer period of time. All the other charts we're looking at 3 months in time. This is 3 years in each one of these charts' case. And every one of those candles that you see on the chart in front of you is 1 week in time as well. So it's a longer term approach. A lot of times the way I kind of describe this is for those of you that have maybe 401k money that you can't actively trade, where you kind of have to make a decision maybe once a month or once a quarter or what have you. This can be a way to kind of see what's going on with the markets and maybe help you make some decisions. Of course, it's not a recommendation or advice, but just gives you a better gauge as far as, should you be in the market or should you not be. The idea here is to try to capture the majority of the trend. Going into it that you're not going to get out at the top and you're not going to get in at the bottom. That's just the nature of it. The less than sensitive nature of this system is what would have kept you bullish all of the last 2 years as well. So remember, it works on both sides of the coin, but as it stands right now, what we're looking for are those postures changing from bullish to bearish by seeing this orange line come down and cross below the blue line. And in all 4 of our charts cases, we're just not seeing that. In fact, we're seeing expansion away from the blue line in all 4 of the cases. For a while there, the Dow was looking a little bit suspicious, where we saw that orange line starting to come down and it was starting to question whether it was going to stay above that blue line. But notice, even the Dow here sees that orange line starting to move higher. Now, one other way you can test that with your eyes, if it's hard for you to see that, if you have a small screen or if your system's blurry or what have you, that's another thing I should mention. We get comments all the time. Hey, we can't see your screen when you're doing it on YouTube. Now, most of you that are premium students know that we do our live classes on WebEx, so there we can control some of the resolution. On YouTube, we do upload it at 1080p, basically the highest resolution we have available to us. So usually when you guys are having blurriness on the YouTube videos, it's not from any of the uploading or rendering or anything like that on our end. You just need to go into your lower right-hand corner, click the resolution toggles on your end as the user of YouTube, and that will usually resolve that issue. So anyway, I know most of you know that, but we still see those comments from time to time that it's helpful to remind you every so often. So when you're looking at this, if you can't see it within the colored background, one other trick for you is notice that we have this MACD2 line set up below each one of the charts as well. And basically when this black line is going away from the pink line, it means that this orange 10-period exponential moving average is expanding away from the 40-period moving average, which if you're bullish is what you want to see. So in all of these cases, notice that that line is now starting to go higher. And so that's a good sign. It's showing that the bulls in the near term are much more in control than the bears in the near term are. All right, let's do some 12 grid analysis now as well. All right, so starting here with the intermarket analysis 12 grid. It's a reminder of what we're looking at on this chart, which is chart 4E for those of you following along at home. When we see the background colors as that light green color, that means that the intermediate posture is bullish. And if you see the background color being pink, that means that it's bearish. Now, I know some of you are red-green colorblind, and one thing that you guys can do if you're having a hard time with the colors, remember that the labels of each of these charts should show you the intermediate posture. So if you kind of know how to set your posture using that intermediate/green line on the market forecast, then you don't really need to know what the color background on the charts are either. So just a heads up on that. For most of you, hopefully the pink and the green is somewhat useful for you to quickly spot it with the snap of the fingers. But as we look at these different movements within the market today, not a whole lot of really robust activity out there. I would say that crude oil had a nice move. Now, I talked about that 2 days ago. We talked about how we had that oversold cluster signal over there, and I think we took the trade on, what was it, National Oil Well Varco on that day. So that continues to be somewhat promising on crude oil down below, where we had this huge rip lower below the moving average to a point where we got to oversold conditions. Now the thought process is potentially setting ourselves up for a reversion to the mean back higher. Now, of course, if that happens, that should help some of those energy stocks out there as well. So that was one of our bigger movers here today. Crude oil was up 1.8%. You will notice that the VIX was up 4% today, so that was maybe somewhat interesting there, but keep in mind the VIX is basically scraping 3-month lows at this point, despite the fact that it was up 4%. So for those that have already sold premium, you're probably applauding the fact that the VIX continues to drift lower. For those that have been waiting in the wings to sell premium, then maybe you're not quite as excited about that situation. One other thing that I would point out here is the Treasury yield. Notice the 10-year Treasury yield. It's kind of the chart that I'm circling right here. That was a peculiar type of movement that we saw here today. Notice that we've had kind of a reversion to the mean back higher for the 10-year Treasury yield as well. And right when we got to that downtrending 30-week move, or actually in this case 30-day moving average, we basically are now using it as a resistance area. So that's not necessarily a good sign. Yesterday looked more promising where we went right up to it, but today was the real test of that line, and unfortunately it just wasn't able to hold. Well, I say unfortunately for those of you that want to see rates going up. Remember, there's a whole class of income-oriented investors that are probably begging for rates to go lower, so you might be cheering that on. But it is kind of interesting that it got stuck right at that moving average. You know, sometimes those moving averages can be used as magnets when price gets too far away from it, like it did here and like it did here. In other cases, it can be used as bounces as well. And right now, it makes you wonder if after a nice little rally in interest rates, is that going to be a bounce back down lower at that point? So we're going to keep our eyes on that because it does cause reverberations throughout so many other asset classes depending on its income appeal. Let's go ahead and take a look at another set of 12 grids here, this time the foreign markets. And as we look at these, you know, some good news to report, which is most of these markets are bullish. As you can see, the background color is green in all of the cases except for Brazil and Mexico, who remain our laggards. And that's been kind of the story here for the last several weeks. Those areas of the world have truly struggled. But we are starting to see some rebounds in the rest of them. As I mentioned on Tuesday, the trends of a lot of these foreign markets aren't necessarily overly enticing. But if you're going to look for the strongest ones out there, I would say Israel remains kind of that strong one, although its candle today was a little bit of that bearish engulfing flavor as well. Also, keep your eye on Germany. I did hear some news out of the German banks here today, so I don't know if that's what's causing it, but Germany was actually down 1.2% today, and kind of like the 10-year, remember the 10-year was reverting back to the mean, the 10-year yield, U.S. government yield that I just talked about, and then used that moving average once it got up to it to potentially bounce back down. It almost looks like Germany at this point is kind of reacting the same way. Of course, the German economy does have some big banks out there that are always in the news. Commerce Bank and Deutsche Bank, of course, were in the news here today. And so it makes you wonder if the entire German stock market is kind of reacting like the U.S. 10-year Treasury yield at this point. So keep your eye on that story as well. And as we look at the U.S. sectors now, this is the 12 grid that will focus only on the S&P 500 companies and the sectors that make up the S&P 500. Notice that the S&P 500 itself is in the upper left. As mentioned before, we continue to retain our bullish posture on the S&P 500. So it's not a big surprise to see so many of the sectors in the green here at this point. The only one that remains bearish is actually utilities. You can see utilities were one of our best performers today. Again, going back to what we just learned a moment ago about interest rates. Interest rates struggled today after meeting some resistance and fell back. And remember, utilities typically do well when that occurs. So if you expect that bounce down in interest rates to continue in the days to come, I would assume that utilities will be relative outperformers in that environment. Of course, if you think the opposite, then the opposite would likely be true. The good news is most of these charts actually look better than the foreign markets that are out there. So kind of tells us that the money is flowing into the U.S. financial markets and is happy there. Remember, this is the most liquid batch of companies on planet Earth that we're fortunate enough to have access to in the United States. And so for a lot of us that are based here in the United States, that's actually a blessing for us because that's where the strength is anyway. One of the things that I will point out is that, again, like the Nasdaq index, the technology sector specifically does have kind of that rolling over feel to it here today. I did see Facebook as an example was down here today. Discretionary was more of a doji looking candle today, but that has been one of our stronger sectors out there. Some of the others that are catching my eye, this one right here, this is energy. So this is what I mentioned before. We saw oil prices kind of reverting back higher off of that oversold condition. The energy stocks themselves, XLE, this is looking reasonable here for a bounce candidate. So keep your eye on some of those oil stocks that were hot as a pistol for much of this year and then took a last couple of weeks off. They might be gearing up to make another move higher here yet again. And then I'll just point out down below here the consumer staples. I brought those up in the intro. Part of the reason I brought that up, I was talking about a company that got smoked here today. First of all, be aware that the consumer staples were up about 0.62%. And so other than energy stocks, they were actually the second best performer on the day. And that caught me by surprise, quite frankly. Reason for that is many of you follow me on Twitter, and every morning at 9 a.m. you come into my Twitter feed. And let me just show you here real quick since I got it pulled up. Remember, my handle's at Brandon Van Zee, all one word. And at 9 a.m. Eastern time every trading day, I put together this 9 at 9, letting you know which stocks are up the most and down the most in the pre-market session, so that way you can kind of prep your mind for what is likely to occur once the market actually opens up a half an hour later at 9:30 a.m. Eastern time. And you'll notice here right up at the top was Smuckers. Smuckers was down 8% at that point. You'll also see some stocks like Kellogg down here, down 2%. General Mills was down 2%. So my own expectations today were that it was going to be a rough go for the consumer staples companies. So it was by my pleasant surprise, because I do have more interest in the staples companies myself as a dividend growth investor. It was my pleasant surprise to see actually good performance out of the staples here today. Now, Smucker remained down, SJM, but it finished a lot off of its lows, meaning that pre-market was down 8%. It ended up closing down 5% here when it was all said and done today. But if you then compare that to its sector itself, XLP went up nicely, telling me that most stocks within the staples space actually went up today despite the beatdown on one of its key component with Smuckers there. So what I wanted to do is go kind of hunt around to see who are the big winners in the staple space, where is there positive activity, and one name that I uncovered there was Costco, obviously well known to many of you, but you can see here with Costco that it is bouncing nicely off of that rising 30-day moving average right there. So a pretty nice little chart there out of Costco, doing something that most consumer staples aren't doing. Remember, the chart of XLP is basically flatlining near the lows of the 3-month, trying its best to bounce. Costco, one of the key members of the XLP, has already been in vogue. So if there's a further swing of money back into XLP, then a lot of times the leaders that have been the most resilient are going to be the ones that kind of drag the rest of that sector with it. So anyway, that's a nice looking bounce out of Costco here today. It not only bounced off of that 30-day moving average yesterday, but it also cleared. It could be kind of one of those interesting slash breakout slash bounce trades. It bounced off the moving average. It also broke out today above these prior highs that we were contending with in mid-May right there. So Costco's looking kind of interesting. And so for our trade application example here for the day, I thought we would practice what's known as a bull put spread. Now, this is also known as a credit spread. I was kind of going back and forth with one of my students about that here today. Sometimes it gets confusing because there are different terms thrown around for these different trades. So just understand that when we say something like a credit spread, it's a generic term, meaning a spread that we start off with a credit. And that could be either a bull put spread or a bear call spread. So you could either be bullish or bearish. The credit spread isn't telling you whether you're bullish or bearish. The credit spread, name or definition is just telling you that you're starting the trade with a credit. So in this case, we could call it either a short bull put spread, or I'm sorry, a short put spread or a bull put spread. Either one of those two terms are interchangeable with one another. I know that can kind of get confusing for some of you, so just be aware they are one and the same thing. A short put spread and a bull put spread are basically the same thing, and they're both considered a credit spread, not the credit spread. Okay, so with that, let's go over here to the trade tab. I've got Costco pulled up, ticker symbol COST. And for this particular trade example, I'm going to focus on the July weekly contracts that expire right now. And this is, of course, Thursday afternoon. So by the time you're watching this video, it might be different. But right now, they expire in 36 days. And so for that, I'm going to come over here to the right-hand side where we've got the puts. And I'm going to look for a delta that's close to 30. Well, we have one spot on. Right there is our 30 delta. That takes us to our $197.50 strike. That will be the strike that we're going to sell. And we're going to buy the 195 strike as part of our protection for this trade. So if I right-click on the 197 put and then go to sell vertical, that'll load up our trade down below. And you'll see that it's going for about 55 cents right there. That's right in that neighborhood of about a 30% return on risk, somewhere between 25 and 30%. So a lot of times that's kind of the neighborhood that we're shooting for the most part. Remember, these are known as higher probability trades because it allows for a flexibility in outcomes and you still potentially winning your trade idea, meaning this. Costco is currently trading at $202.57. If we're selling the 197.50 put down here, we're basically saying we want Costco to stay above 197.50 between now and expiration day in 36 days. So what does that mean? Well, it means that Costco could continue to go higher, just like we've seen recently. After all, that's why we're attracted to it. It's a very bullish chart. So that's entirely possible that that could occur. It could just continue to drift higher. Of course, that would be a good thing for our bullish trade here. On the other hand, if maybe it's about ready to stall out or maybe news comes out of the blue and disrupts the trend of the chart, maybe it ends up going sideways. If this stock stays exactly at $202.57 for the next 36 days, we'll be giddy as all get out. Now remember, that's one of the key differences between doing something like this as opposed to just buying the stock outright. If you buy the stock outright and in 36 days from now it's still trading at $202.57, you're not making any money. In fact, the only thing you've done is given your broker some commission money. On the other hand, if you've sold a bull put spread, even if the stock goes sideways, you're going to still keep that 55 cents worth of credit that you took in to start that trade. And then, of course, if it does go down, we can absorb a small move lower in price. We just can't absorb a big move lower in price. So if this thing were to go from $202.57 down to, let's call it $198, we're still good there because it still remains above $197.50. On the other hand, if that thing just takes off really, really bad to the downside and let's say ends up at $190 in 36 days, then of course we should assume we're going to lose money on that trade. Anytime we place a bullish trade, we should assume we'll lose money if the stock doesn't do what we think it will do and it goes down instead. So a variety of outcomes in this case on a strong stock within a previously weak sector that is starting to show some signs of life here. So with that, let me go ahead and click confirm and send. We'll review that one last time and then just ship that off to the marketplace. All right, well, I want to thank you for joining me here this evening. Always a pleasure to get a chance to go to work for you here. Remember, if you get value out of these videos, do me a favor, click the thumbs up on the YouTube channel itself, and then go over to Twitter, go to my Twitter feed at Brandon Van Z, and then just go up to the top where I've pinned the Market Outlook post and click like and retweet if you want David and I to continue to do these videos on a daily basis going forward. So with that, I want to wish you all the best with your trades and your investments. David should be back with you tomorrow, and then I'll probably be back with you early next week. So with that, have a great night, everybody. Take care. Bye-bye.